In this video, I've got with me Lee Ohana. Now, she is listing the property back behind us, this 8-unit, $1.2 million multifamily property. We're going to talk about why first-time investors and seasoned investors need to watch this video to find that hidden opportunity in our market. Now, guys, I'll tell you that this video could be the difference in whether you make money on your next deal or whether you lose money. Let's get into the video now. All right, guys, we're on site today right here at 6501 Somerset Drive. This property is excellent. It is an 8-unit property, all having 1 bedroom and 1 bathroom. All your standard stuff, microwave, a refrigerator, range.
Let me add this, Brendan. I just, want people to understand that this is a true 8 1-bedroom, 1 bath. This was built, with the intention of 8 1-bedroom, because, we can see a lot of times houses that have been converted into a multifamily, and then they're like, we have on the market 21 units, but it's not a really true 21 units. That's like true 18-bedroom, and then they took the office, converted into a room, and then, so we can see that all the time. So this is a true 8 1-bedroom, 1 bath. Here we can see right here all the storages that we have in the back of the building.
Yeah, super cool. Absolutely. So all the units down here have storages attached to it, which is super cool. And there's a cool little sidewalk that we're on here. Now, I do want to draw your attention to the surroundings. I cannot wait to show you guys what's around here. All right, guys. So as you can see back behind me, there is an absolutely stunning apartment complex.
Yep. So let me just add a little something about it. You as an investor, I really rather you to buy the worst house in the prettiest neighborhood. And when I say so, if you can look at the neighborhood, just look around. We have a very nice neighborhood. It's a very prime located neighborhood. So yes, we have this, this multifamily that it's not the nicest one, like when you look at, from the outside, but because we have all this surrounding. So you as an investor, that's a very, very smart decision for you to make when you're taking those factors into consideration.
Absolutely. So basically, let's just tilt this way.
Yeah.
So, I mean, in comparison to all the surrounding properties, it does not look as nice. It is the value add opportunity right here in this space. Everything around this looks great, which means you could purchase this property most likely at a discount, come in, renovate it. You've already got some equity in the property now. You've bought the opportunity in the market. Everything around us, look, I mean, it's stunning, nice, beautiful sidewalks. I mean, it's gorgeous. So this is the kind of opportunity that savvy investors look for when they're looking for commercial multifamily property. Let's get in unit 3B. All right, so as soon as you walk in, you'll notice nice tile all over the floor. Of course, you do have your kitchen. It's effortlessly flowing together, really seamless layout. You do have a granite countertops, stove, and of course your little nook here, little bar, but everything that you need. And we've got the bedroom, as you can see here, pretty spacious, pretty large. Got a closet in the corner, another closet here, and then you actually do have an updated tub shower combo here, as you can see, and to get a nice vanity. And guys, that pretty much wraps it up for this 1-bedroom, 1-bathroom unit.
Alrighty, so basically all units has the same layout, the way we just saw, but some of them has been renovated more and some have been renovated less. This one, like you saw, had some kind of renovation into it, which is kind of nice. And just to mention, just today we had 2 showings for tenants that are interested to come and get this apartment. So it's just showing us the demand that we have for the property, again, because of the location, because you won't find many 1-bedroom, 1-bath, and for this location, it's actually great for pretty much local people that they're looking to be proximate to the beach, proximate to pretty much all surrounding, and have a 1-bedroom. That's kind of rare, and people looking for that.
Yeah, so 2 things I want to unpack here. One is obviously this is going to be a different segment of the market that's going to rent here. Most likely it's going to be your budget conscious person.
Yeah.
Because like right across the street, they're going to pay a premium to be able to live in something a little bit nicer. Now,
Exactly.
furthermore, let's talk about the location. I mean, how far away from the beach are we?
What, 5 minutes walk?
5 minutes walk. All right, guys. So where can you go? And your average rent here is what, like I'd say $1,250
Yeah.
per month. So, you know, where can you go in our market and for $1,200 be 5 minutes from the beach? It's kind of hard to argue with that. Yes.
I like it.
Yeah. So, okay. On top of the fact that 2 people have already shown up to see the 1 vacant unit that is here, and the turnover is super, super fast. I mean,
Super.
would you say it's less than 3 months whenever one goes vacant?
Less, much less. Because again, people are looking to find a location that it's, first of all, the neighborhood. The neighborhood is quiet. It's a nice neighborhood where we're talking with just look in the surrounding. Just look at this.
Yeah.
So the neighborhood is nice. We have here, not too far away, we have the YMCA. We have here Food Lion. We have here all the main, you know, supermarkets. We have the beach, 5 minutes, you know, walking distance. It's just like, for location, that's the perfect location for, you know, for anyone, for a small family, for a single, you know, a person, for a student, for whatever it is, you know.
Yeah. So like, we're not talking about being in Conway, getting a multifamily property that's 30 minutes from the beach.
This is the heart of Myrtle Beach we're talking about.
This is the heart of Myrtle Beach.
Exactly.
So like, there, you know, essentially there will always be demand for this
Always.
place.
And we have some properties that we manage in other places. This is, I think, one of the fastest turnaround for, you know, to get it rented. So we just had a tenant move out, and we're just gonna have a tenant probably in the next few days move into that vacant property.
All right, Lee, so talk to me about medical. How far away is medical from this location?
So I would say less than 5 minute drive. We're here on 65 Avenue, and on 82nd Avenue we have Grand Strand Hospital, and the surroundings, all those clinics. So we're literally 5 minutes drive, which is very, very important. Think about it. When you have an emergency, you have quick, you have a quick response. You just need to go. It's just very, very prime. You have the USPS right there on 67.
Yep.
So we're talking 2 Avenue. You can literally walk there.
Yep. Yeah. So, okay. And then, so basically, and I know it sounds almost too good to be true, but everything is like 5 minutes away. Like Broadway.
Because it is the heart of Myrtle Beach.
It's the heart of Myrtle Beach.
We're talking the heart of Myrtle Beach. So,
so Broadway at the beach, 8 minutes away?
8 minutes drive.
Okay. Employment centers. You know, where would people work that live here?
It's going to be varies, you know, because we're talking Myrtle Beach. People come here to do pretty much everything from everything. So, and we see, especially after the pandemic, we can see how like everyone moving from New York and all from all, you know, all kind of those states, and they want to work remotely.
Yep.
So it's because it's for them, they get the same salary, you know,
at
because
the same place,
and just
to be at the
cheaper.
beach. Yeah, they live cheaper.
Live cheaper than live in New York. And look, this is, we're talking about like, it's not even spring yet, and look how beautiful and how sunny it is today.
Yeah, for sure.
So Myrtle Beach is a prime place to live at.
Absolutely. So,
and we see the growth. Myrtle Beach is, we see
6% year over year average.
We see the growth. We see how this is a destination for many, many, many people to just come here, and you see how you can just see by the construction that literally. Sorry, but literally that's how she, you know, that literally that's going around everywhere. There is new construction there.
Yes.
You know, they did a study in Myrtle Beach City. Let me tell you about that. They did a study, and they found that in order for them to have the demand in the next 10 years, they will have to create, I think, 1,800 more units each year in order for them to actually have the demand. And that's Myrtle Beach. Myrtle Beach did a huge study about that, and that's a big thing. So we have people from all over. So Myrtle Beach, and there's not enough land to build.
They're building they're now building out in Conway.
Yeah,
like they're building 30 minutes away. They're building in Loris, and Loris is 45 minutes away. Conway is 30 minutes away. You maybe 20 or 25 minutes. They've built out all those areas. Myrtle Beach has been the fastest growing place out of the 150 most populated places in the entire United States for the last 3 years in a row. Basically, baby boomers are retiring at a rate of 10,000 per day, and they're moving to Myrtle Beach into Florida, and they've discovered that Myrtle Beach is the value buy compared to Florida. They get more for their money here. So demand is through the roof for rental units.
Oh my God,
here.
I cannot even explain you. I work with a lot of developers, and they're looking constantly for land. They call me, Lee, just give me land, like find land. I'm like, you know, there is not enough land. So hey, if you're an investor, and it's, you know what, it's actually a perfect for a pretty much a start, like an investor that it's not really, you know, because that's not a huge project.
Yeah,
it's not
first-time investor.
Yeah, it's first-time investor or someone that, you know, this is in his price range. That's actually perfect for them, because, you know, remember that sentence I'm about to tell you. What look to you today expensive, tomorrow will be damn cheap. So just remember that, because you know what we thought, literally what I thought 5 years ago, oh my God, that's too expensive. 5 years later, fast forward, what do you see? Oh my God, I wish I bought this property.
I know.
So I don't want to, I don't want
themselves.
you know, so whatever looks to you today expensive, fast forward will look to you damn cheap. So
yeah, and
think about
hey,
it.
I had a client who was debating on buying an oceanfront condo. He was going to invest before COVID. Then COVID hit. He didn't do it. And then he bought the same exact unit that he was going to buy pre-COVID for $100,000 more, like two or 3 years later.
That's the numbers that we're talking about.
Yeah.
So sometimes, you know, you just need to act, because if you're not going to act now, later is just, you know, you're going to lose this opportunity.
That's right. You won't be able to make as much a return for your investment. Obviously, guys, your cash on cash return is going to be cheaper if you buy it at a value now versus investing that money a year or 2 years later. So don't let fear hold you back. Step up to the plate.
And don't let interest fear you back, because you know what we say in real estate, you marry the house, not you date the rate, you marry the house. So in a few more years, you're just gonna have to refinance. If that, you know, that's what scares you.
Absolutely.
You know, the interest rate.
Absolutely.
You know, so
in a
you
few
marry
more years,
the property, but you don't date the rate.
You refinance the house when the interest rate's lower, and we all know that I believe that the interest rates, now that Trump's been elected, are going to be dropping, you know, here anytime soon.
But later on, when, let's say, your investor bought this property, right, for whatever price it was, and then he bought the property, put some money into it, actually it will go up, you know, the value will go up. So then he's going again to the bank, he's refining, taking some money more for that property, because the value up, and then he put it in another property, and that's how you create wealth. So you actually create wealth with not your money, with other people's money.
That's right.
So that's what I want, you know, for investor to understand that today, it might sound, you know, some people would say, oh, it's too expensive, but don't think about that way.
What she's talking about is a cash out refinance. You know, you buy this property now, you wait a year,
we need to teach them.
You fix it up, you make it a value add, you get it appraised, it appraises for more than what you paid for it. You go to them and say, hey, I want to pull the equity out of the property. Then you take that money and you pay down on your next property.
And then actually your next property, you actually buying with not your own money, with other people's money, with the bank's money. So I love this, you know, this idea, because that's the idea, that's how to create wealth. That's literally how, you want to create wealth for generation.
That's right. All right, guys, so let's hop into the numbers on this property right here at 6501 Somerset Drive. Now, the purchase price for this property was $1.19 million. We're talking about $1.1 million, right at $1.2 million. Your acquisition cost, we've got you at $23,800. That's your brokerage fees. Your loan costs were $17,840. That's your origination fees, 2% of the loan amount to actually purchase it and finance it. Your actual mortgage came out to $892,000. That is 75% of that original purchase price of that $1.2 million. And then your initial investment. Now, your initial investment in this property is going to be that 25% down, plus those brokerage fees. That's $339,640.
So, hey, I just wanted to say something right here. Not all of us are amazing with everything. Everyone needs to know what they're good at. So, we are, as a broker, we like numbers. This is what it is, because at the end of the day, especially for commercial real estate, it's all about the numbers.
Dollars and cents.
It's all about it.
Yes.
And I totally get it. You're an investor, whatever it is, but you know, you don't know what to do exactly. You don't know how to kind of run the numbers. That's why we have you here. That's why we're doing the numbers for you.
That's
Just
right.
why we're, you know, we actually analyze the property for you, and we can walk you through how to do it, how to calculate it, because not everyone can understand and have to, you know,
Yeah.
to have the
Yeah, and we're going to take into account what
And-
your capital gains are. We're going to take into account, what how much you can depreciate this property to get the right tax write-offs, so that you high income earners don't have to pay as much taxes.
And again, yesterday, we came to the office. We literally sat 3 hours
Yes,
analyzing every number, put it into our special CCIM chart.
That's right.
That not everyone has a CCIM. I don't know if you're familiar with the CCIM or not, but CCIM is say what CCIM is.
It's a commercial certified investment member.
Yeah.
Basically, it's the standard in our industry for a serious broker that does commercial investments.
So both me and Brendan are part of this program, which takes kind of time to finish it.
That's right.
Because not only that you need to pass all the courses and all the semesters and all the exams and the huge exam, but you have to actually need to show a portfolio of stuff that you have done in order for you to be a CCIM. So when we're talking about, theories, we're not talking just theories. We actually know to bring it into actually numbers and actually actions, and we can help you go through that path.
And analyze and see, hey, is this deal a good fit? Does it make sense? How is it going to impact my taxes? How am I going to have to pay capital gains on it? What's the net present value of this property if I've got a 10% hurdle rate? Like, guys, that's what we do.
Exactly.
So let's hop into the taxable income section of the worksheet. Now, guys, I want to point out to you that your potential rental income for the first year was $121,200. Now, how I arrived at that number. Essentially, there are 8 units. We have one unit that rents for $13,800, another that's for the year. Another for the year makes $15,600. Another 3 of them make $15,000. Another one makes $15,600. That's number 6. Number 7 is $15,000 a year, and then number 8 is $16,200. Now, that's the annual rents on all 8 units at this multifamily property. The total is $121,200. Now, we've estimated a 90% occupancy rate because these units are in such high demand. And to be honest with you, it's probably lower. Yeah, honestly. But, we just threw 90% out, nice round number.
Probably higher occupancy, like 95.
Oh, excuse me. Yeah, probably higher occupancy, lower vacancy rate. Yeah. So, you're probably somewhere around 95%, even maybe 97% occupancy for this unit.
Yeah, which is unlike for usually multifamily, because usually we'd like to calculate the number a little bit higher just to be on the safe side. But based on numbers and based on the experience that we have with this specific property, so that's why we can definitely say that that should be the accurate number.
Yeah, for sure. Now, vacancy and credit losses, we've got you at $6,060, bringing you to an effective rental income of $115,140. Essentially, you take the $121,200, you subtract out the $6,060, and it leaves you with the effective rental income of $115,140. Now, there was no other income. Other income would be like a billboard or a parking lot associated with this property that you can charge elsewhere for. All right, moving right along. Now, there's no other income, so that $115,140 drops down to the gross operating income. Now, your operating expenses for this property, we've got you estimated at $34,542. Do you want to kind of talk just a little bit about those operating expenses, maintenance,
the thing is,
insurance?
It's pretty basic. It's pretty low maintenance, as you see.
But they probably spend $1,000 a unit a year,
if that.
Yeah.
If that.
Insurance, we've got you at $500 a unit or something.
Something like that.
Yep.
Another thing that you can add. So right now there is a common water meter. So it's approximately between $400 to $500 monthly on that bill. And the thing is that you can literally add it to the rent. So you can charge another extra $100 for each tenant, and you actually can cover that cost and do more. So that's definitely be more income in the future if you want to cover that expense, and you want to raise the rent a little bit. and you can say it in the, in the contract, it's $1,250 plus $100 for water, since the owner pays for the entire building for
and then
so
just
that's a potentially
just pass that on through to the tenants.
Yeah,
absolutely. So operating expenses, we have you at 34,542. Your net operating income, if you subtract the operating expenses from your gross operating income of 115,140, your net operating income was 80,598. Now the interest for the first year on the mortgage, again, that's 75% of that ask price of 1.2 million, and that mortgage was 892,000. The interest on that mortgage that you can write off was $62,008. Now we've got you estimated for cost recovery, that's another word for depreciation, on the improvements at $33,210. All right, so I'm going to just kind of walk you through how we came up with that number. We checked the assessor's records. We found out, basically what the assessor valued the improvements at this property as well as the land. We got a total number there. And then we took the value of the assessor's improvements, divided into that total number to get a percentage of the purchase price that we could successfully and defendably write off on our taxes. It's that simple and that easy. Because we use the basis percentage as the county assessor's rate, well, that gives us a defendable basis. We didn't just make up a number and say, hey, Mr. IRS, we want to write off, this amount. No, we have a defendable basis, again, based on government. Now,
and I just want to add again, always talk to your CPA. We are not a CPA.
Oh, for sure, all day long.
Always talk to your CPA, because at the end of the day, if you have a good CPA, it can save you tons of money. So always talk to your CPA and find ways to kind of, save up on your property, because if you have a good CPA, he'll save you tons of money.
Absolutely.
He'll write off some,
the secrets. They know what to tell you to do.
Like if you have a good broker, you'll save a lot of money, or you'll do a lot of money.
Or you'll save a lot of time and you'll make a lot of profit.
So it's always about the right people.
Yep, all day long. Could not agree more. We had you at 33,210. Your amortization of loan cost, we've got you at 3,568. That's that 2% of the loan cost amortized over a 5-year loan period. So we basically just split up the 17,840 and across 5 years. Then we have your taxable income. It was actually negative 18,188, because your cost recovery and the interest that you can write off on this property and the amortization of your loan cost, basically did not give you any taxable income, which is great. Now, your tax liability that you would have to pay in taxes if it were a positive number, again, in our instance, it is a negative number, was $6,730. I've got you at a 37% tax bracket rate, and that is 37% of that taxable income of $18,188.
Just let me say one thing, Brandon, because for some people, for some, investors, and for some, individuals, whatever we just spoke, numbers, it might sound for them like a Chinese. It's like, what is he talking about? 37% right here, 25% here. Like, you're driving me crazy. They just want to fast forward that video and to actually, to understand. They just rather see the surrounding, the shape of the property, all of that. So, which I get it. So again, if you don't understand all these numbers, sounds very, very, confusing to you, it is okay. You're not supposed to know those stuff. This is something that we're supposed to do.
This is what we do. And that's why you hire a broker that's competent, knows what they're doing, and can run the proper financial and market analysis on your commercial investments so that you're making a sound and savvy investment decision.
Because it can, you know what, Brandon? It can sound very confusing to a lot of the people. And some people, that's why, especially I'm talking to the first investor, for a first investor person, like a person that had never invested before and want to do that move, and you want to move into a nice property, you want to invest, but you don't know how. It just sounds like overwhelmed for him. Like the numbers, this, that, what do I do? So don't worry, it's not that complicated. It's actually pretty easy.
It's pretty simple, and I'm going to say this to you. It's as simple as calling the right broker and having the right conversation. Like 843-360-1737. Literally, I can walk you through step by step everything in this spreadsheet, explain to you how I arrived at these numbers, so that way you get a comprehensive learning experience and you become a better investor. It's that simple and that easy, guys. Now, Am I going to expect you to give me proof of funds? Of course. Are you going to have to give me a pre-approval if you're buying a property? Yes.
I don't want to spend your time. You don't want to spend my time. I want to see that you're actually capable. So maybe this property is not going to work for you, but we have other properties that we might have a good suit. So for actually when we ask for a client, hey, give me a proof of fund, we actually ask it for you. So we can actually make sure this is a good fit for you or it's not a good fit for you.
That's right.
So you can, talk to both me and Brendan.
That's
we
right.
can guide you through that. That's why we both of us have been doing it.
So give us a call and don't be strangers. Lee, what's a good phone number for you?
386-262-4585.
That simple and that easy, guys. Yeah. Pick up the phone. So let's get into the cash flow section of the worksheet, guys. So your net operating income, again, was $80,598 in the first year for this property. Your annual debt service, that was $75,654. That is 12 months worth of payments on the mortgage. Now, if you take your net operating income of $80,598, you subtract out your annual debt service, you were left with your cash flow before taxes. And again, that was $4,944. If you factor in your tax liability, which you were positive technically $6,730, it gives you a cash flow after taxes of as much as $11,674. All right, let's real quick run through that mortgage data on this property. The amount of your mortgage was $892,000, 75% of the purchase price. We've got you at a 7% interest rate over 25 years. We have a loan term of 5 years. You're making 12 payments per year. Your annual debt service was $75,653.64, and then your loan cost and fees for this loan were $17,840. So just keep in mind that this is just an assumption. All of this workup and all of these numbers is based on an investor interested in paying 25% down.
Yeah.
If you paid 50% down, 70% down, if you paid more down,
so the
obviously
numbers will change accordingly.
All those numbers change. Yep. So we just ran a pretty general, basic, hey, least amount of money in this deal. This is kind of what it looks like. I get calls and emails pretty much every day, all the time, from investors just like you looking to invest in commercial real estate deals, in short-term vacation rental properties, no matter what it is. If it is real estate, whether it's industrial, office, retail, medical office, I don't care what it is. If you want to invest in it, then you need a savvy investment broker to run financial analysis, market analysis, and feasibility studies on your investment to make sure that you are making a worthwhile investment. No matter what market you're in, pick up the phone and give me a call. It's 843-360-1737. All right, so let's dive into the alternative cash sales worksheet. Now, guys, there are 3 separate calculations that take place in this worksheet. One is the calculation of your adjusted basis. One is the calculation of the capital gain on your sale. The other is the calculation of the sales proceeds after tax. Now, your basis at acquisition was $1,351,964. That's those brokerage fees along with the asking price. The cost of recovery taken over the entire 5-year term on this deal was $170,369. In other words, you're going to be able to write off $170,000 on your taxes for owning this property. Now, if you subtract the total cost recovery from the basis at acquisition, you will be left with the adjusted basis at sale of $1,181,595. Now, let's work through the calculation of your capital gain on sale. So your sales price was $1,351,964. The cost of sale, again, those brokerage fees, was $27,039. The adjusted basis at sale, line 5, was $1,181,595. Your gain on the property was $143,330. That's how much your property gained in appreciation over the 5 years that you owned it, based on if the cap rate stayed the same at that 6.7%. So if nothing changes as far as the cap rate goes, your property still appreciated, this property appreciated $143,330. Now, the straight line cost recovery, we're going to subtract that from the gain on sale, and we will be left with, again, that gain from appreciation. And here we were left with $27,031 to the negative because we actually wrote off more than we appreciated, if that makes sense.
Yeah.
Now, moving right along, your loan fees, you were able to write off $17,840, and then your ordinary taxable income came to $44,879. Now, the last section of this worksheet is the calculation of your sales proceeds after tax. Again, we got that sale price at $1,351,964. Again, your sale price was $1,351,964. Your cost of sale, again, those brokerage fees, was $27,039. Your mortgage balance for the 5 years that you had the property was $1,129,644. And then your sales proceeds before tax were $195,281. Now, there is going to be something called capital gains recapture tax. There's also going to be something called cost or recovery recapture tax. The IRS is essentially going to want to get a piece of both of those write-offs that they gave you. All right, so just know that. And we're going to calculate those now. So if you take your $191,281 and you subtract out your ordinary income tax at 37%, that is $16,605. Then you subtract out the straight line recapture tax for your cost or recovery. That was basically 25% of the total cost recovery or depreciation that you wrote off on this property. Again, that brought you to a total of $34,074. We're also going to subtract out the capital gains recapture tax, which is 20% of the total gain on the property. That was $6,760. We're left with the sales proceeds after tax of $184,573 after you've owned this property and successfully sold it at that same 6.7% cap rate in year 5 or year 6. I get calls and emails every day from investors just like you looking to make their move into the Myrtle Beach market. They want to invest in short-term vacation rental properties. They want to invest in oceanfront condos. They want to know where the best deals are in our market. Well, guys, you're talking to the right person. 843-360-1737. I'm going to help you put your hands on the best deals in our market. If you're a first-time investor or a seasoned investor, if you're 1 year, 6 months, 3 years out, I don't care where you are in the investing process, pick up the phone, give me a call, send me an email, shoot me a text message, and let one of the many stories on our channel be one of your stories.